When it comes to investing, one of the key strategies is to look for undervalued stocks. A stock's downfall in price is a good indication of value. As Warren Buffett famously said, be fearful when others are greedy and greedy when others are fearful. Hello everyone and welcome to Omega Finance's YouTube channel. As an investor, looking for undervalued stocks is like being a detective on a treasure hunt. It's a mystery waiting to be solved. Similarly, signs of stocks being undervalued are blueprints that lead us to uncover hidden value and profit opportunities in undervalued stocks. Today, we are going to talk about some signs that indicate a stock may be undervalued and how you can use this information to make a profitable investment. Let's take a look at some of these blueprints. High dividend yield. A sign that a stock may be undervalued is a high dividend yield. A dividend yield is the annual dividend payout divided by the stock price. If a company pays a high dividend yield, it may indicate that the stock is undervalued. Now you may ask, how? It doesn't make sense as high dividend stocks are usually popular amongst investors. One example of an Indian company that began paying dividends and saw an increase in its stock price is HDFC Bank. HDFC Bank is one of the largest private sector banks in India with a strong track record of growth and profitability. In the early years of the bank's existence, it did not pay any dividends to its shareholders. However, as the bank grew and established itself as a stable and profitable business, it began paying dividends to its shareholders. This helped to increase the bank's visibility in the market and attract new investors. As a result of the bank's consistent profitability and dividend payments, its stock price has increased steadily over time. In the past 5 years, HDFC Bank's stock price has more than doubled from around 1,000 rupees in 2016 to over 2,400 rupees in 2021. The combination of strong financial performance, consistent dividend payments, and a track record of growth and profitability has made HDFC Bank a popular investment among institutional and retail investors in India. The bank's focus on delivering value to its shareholders through dividends has helped to reinforce its position as a leading player in the Indian banking sector. Strong growth potential. A stock or company that is currently performing just okay may have significant potential for growth and success in the future. Factors such as low market competition, government-supported schemes, high demand, innovation, and globalization can all contribute to the company's future success and potential increases in its stock price. Investors who recognize these factors and invest in such companies at the right time may be able to reap significant rewards over the long term. To have a clear understanding of these factors, let's dive into more details. Low market competition. If a company operates in relatively low competition, it may capture a larger market share and achieve higher profit margins. This can lead to strong financial performance and a potential increase in its stock price. Government-supported schemes. If a company operates in an industry or market that is supported by government policies or initiatives, it may benefit from favorable regulatory environments, tax incentives, or funding opportunities. This can boost the company's growth and profitability, leading to potential stock price increases. High demand. If a company's products or services are in high demand, it may be able to generate strong revenue and profit growth. This can lead to increased investor confidence in the company's future prospects and a potential increase in its stock price. Innovation. If a company can innovate and develop new products or services that meet unmet needs in the market, it may be able to capture a significant share of the market and achieve strong financial performance. This can lead to potential increases in its stock price. Globalization. If a company has the potential to expand its operations internationally, it may be able to tap into new markets and achieve growth in revenue and profitability. This can lead to potential stock price increases as investors become more confident in the company's future prospects. For example, Adani's stock that has gained strong growth potential is Adani Ports and Special Economic Zone, or APSEZ, the largest port operator in India. Adani Ports and Special Economic Zone has benefited from various factors contributing to its growth potential. These include government support. The Indian government has been working to develop the country's port infrastructure, and Adani Ports has been a beneficiary of this initiative. The government has awarded Adani Ports several port development projects, which have helped to increase the company's revenue and profits. Strategic acquisitions. Adani Ports has made several acquisitions in recent years, which have helped expand its operations and increase its market share. For example, in 2020, the company acquired Krishnapatnam Port Company, one of the largest private ports in India. Focus on efficiency and technology. Adani Ports has invested in technology and infrastructure to improve the efficiency of its operations, which has helped to reduce costs and increase profits. The company has also implemented several sustainability initiatives, which have helped to improve its reputation and attract investors. Diversification. Adani Ports has diversified its business to include logistics and industrial parks, which has helped to reduce its dependence on port operations and increase its revenue streams. As a result of these factors, Adani Ports in Special Economic Zone has seen strong growth in recent years, with revenue and profits increasing significantly. This growth has been reflected in the company's stock price, which has risen by more than 500% in the past 5 years. Adani Ports in Special Economic Zone is just one example of how the Adani Group has capitalized on growth opportunities in India. The company's success has made it a popular investment among institutional and retail investors, and it is expected to continue to experience strong growth in the coming years. Low price to earnings ratio. One of the key indicators that a stock may be undervalued is a low price to earnings ratio. The PE ratio compares the current stock price to the company's earnings per share. If the PE ratio is low, it means the stock is cheap relative to its earnings. Calculating the price to earnings ratio is relatively simple, and it's important to consider when considering whether a stock is undervalued. To calculate the PE ratio, you simply divide the stock's current market price per share by the earnings per share or EPS for the past 12 months. For example, if a stock is trading at 100 rupees per share and the EPS for the past year was 10 rupees, the PE ratio would be 10. Let's take an example of an Indian undervalued stock, such as Tata Steel. As of February 2023, Tata Steel is trading at around 1,500 rupees per share, and the EPS for the past year was around 200 rupees. This gives us a PE ratio of approximately 7.5. Now let's compare this to the PE ratios of some of Tata Steel's peers in the Indian steel industry. For example, JSW Steel has a PE ratio of around 10, and the Steel Authority of India Limited has a PE ratio of around 8. By comparison, Tata Steel's PE ratio of 7.5 appears to be relatively low, indicating that it is undervalued. However, it's important to remember that the PE ratio is just one metric and should not be the sole factor in making investment decisions. It's important to consider other factors such as the company's growth potential, its financial health, and the overall market conditions. Undervalued in comparison to peers. If a company is undervalued compared to its peers, it may be a sign that the stock is undervalued. Investors can compare the PE ratio, price to book ratio, and other financial ratios to those of similar companies to determine whether a stock is undervalued. To check whether a stock is undervalued compared to its peers, you can compare its valuation metrics, such as price to earnings ratio, price to book ratio, and dividend yield, with those of its industry peers. For example, let's say you're interested in investing in a stock of an Indian automobile company, such as Tata Motors. You can compare Tata Motors' valuation metrics with those of its industry peers, such as Maruti Suzuki, Mahindra & Mahindra, and Ashok Leyland. You can check the PE ratio of Tata Motors and its peers and see if it is lower or higher than their average. If Tata Motors has a lower PE ratio than its peers, it may indicate that the stock is undervalued. Similarly, you can check the PB ratio and dividend yield of Tata Motors and compare them with its peers. It's important to note that while comparing the valuation metrics of a company with its peers can be a useful tool, it's not the only factor to consider when evaluating a potential investment. You should also consider the company's growth prospects, financial health, and industry trends before making an investment decision. Insiders buying. Insiders buying refers to purchasing a company's stock by its executives, directors, and other insiders. Insider buying can be a good sign that the insiders have confidence in the company's future prospects and that the stock may be undervalued. To check for insider buying, you can look at the insider trading data of the company. In India, the Securities and Exchange Board of India, or SEBI, requires insiders to disclose their trades in company stock within 2 working days of the transaction. This information is publicly available on the websites of stock exchanges or financial news portals. For example, let's say you're interested in investing in a stock of an Indian software company, such as Infosys. You can go to the stock exchange website where Infosys is listed and look for the insider trading disclosures filed by the company's executives and directors. You can look for insider buying transactions, where an insider has purchased company shares in the open market. Suppose there have been multiple insider buying transactions over a period of time. In that case, it may indicate that the insiders are optimistic about the company's future prospects, and the stock may be undervalued. However, it's important to note that insider buying is just one of many factors to consider when evaluating a potential investment. Insider trading data should be considered alongside other factors such as the company's financial health, industry trends, and valuation metrics. After an idea of the signs, let's now discuss the risks and importance of stock valuation in investing and how to use these signs in your analysis. Before we move to these important points, make sure to hit the thumbs up icon below to like this video. Importance of stock valuation in investing. Stock valuation is like shopping at a clearance sale. You look for discounts and opportunities to buy high-quality products at a lower price. When a stock is undervalued, it can present an opportunity to buy a high-quality stock at a lower price. For example, Adani stocks crashed in 2023 and Nestle India stocks fell in 2015 due to the Maggi noodles controversy. Still, once the issue was resolved, the stocks bounced back, and investors who bought the stocks during the fall made a significant profit. How to use these signs in your analysis? Investing is not a get-rich-quick scheme. It's important to save and upscale your earning capacity first. Just like a small seed needs time to grow into a fruit-bearing tree, your investments also need time to mature. Once you've invested in a stock, forget about it and only recheck it once in a while. Finding undervalued stocks can be a lucrative investment strategy. The signs that indicate a stock may be undervalued, such as a low PE ratio, high dividend yield, strong fundamentals, undervaluation compared to peers, and insider buying, can be used as blueprints to find a treasure. It's important to do your research and take a long-term approach to invest in undervalued stocks. Remember, investing is a marathon, not a sprint. Do you still have any confusion about the signs for measuring undervalued stocks? If you have any questions or comments, please leave them below. We have also uploaded a video on the 5 best dividend stocks in India with high growth rates on our channel, which can be very helpful to you while investing in dividend funds in 2023 and beyond. You can find the link to that video in the description below and in the card. Thank you for watching Omega Finance, and we'll see you in the next video.